Every 14 seconds, a Maersk container ship passes through the Strait of Malacca, and here's the trick. Almost nobody notices where the real money actually goes. Maersk isn't just a shipping company. It's a cash machine built on logistics arbitrage, the ability to move your cargo from Shanghai to Rotterdam cheaper than you could move it yourself. But the profit margins that keep this empire running aren't where you'd think they are. They're hidden in financing, in port contracts, and in a supply chain so complex that most shippers don't even know who's actually moving their goods. So how did a Danish company founded in 1904 become so dominant that it controls roughly 1 in 5 containers crossing the world's oceans? The story starts with scale. In 1904, A.P. Møller founded a small shipping company in Copenhagen. For decades, it was regional North Atlantic routes Baltic trade, but after World War II, something changed. Container shipping didn't exist yet. Cargo was loaded by hand, piece by piece, onto wooden pallets. A ship could spend 6 weeks in port just being unloaded. Then in 1956, a trucking entrepreneur named Malcolm McLean loaded 58 truck trailers onto a converted tanker. Costs dropped by 80%. The modern container age was born. Maersk saw this shift coming. In the 1970s and 1980s, while competitors were still running general cargo vessels, Maersk invested billions in purpose-built container ships. This is where the forensic accounting gets interesting. They didn't buy these ships with cash. They financed them through sale-leaseback arrangements, sell the ship to an investor, then lease it back. The cash came in immediately. The payments were spread over 20 years. And here's the trick. The depreciation and interest payments created massive tax deductions that offset operating profits elsewhere in the group. By the 1990s, Maersk owned or controlled over 600 vessels. But owning ships is actually a terrible business. Margins are thin, fuel costs spike. Overcapacity crashes prices. Maersk's real genius wasn't shipping, it was realizing that the money wasn't in moving containers. It was in controlling the ecosystem around them. They started buying terminal operators. In 2013, they acquired APM Terminals for $4.5 billion, a subsidiary they already owned, but this was a restructuring that consolidated control. Now Maersk didn't just move your container. They owned the port it left from, the port it arrived at, and often the port in between. Each touch point was a revenue opportunity: docking fees, handling fees, storage fees, documentation fees. But there's more. Maersk also owns Damco, a freight forwarding company that books cargo space on ships. So when a customer wants to ship electronics from Taiwan to Germany, Damco might book space on a Maersk ship, arrange trucking from a Maersk subsidiary, handle documentation through Maersk software, and store goods at a Maersk terminal. Every leg of the journey generates a separate invoice. The customer sees one shipper. The accountant sees 7 profit centers. This vertical integration is the real moat. Competitors like MSC or CMA CGM run ships. They're good at it, but Maersk doesn't compete on shipping. It competes on total landed cost, the ability to offer a complete package cheaper than anyone else because it captures every margin along the way. And because Maersk controls so many choke points, it has pricing power. Raise terminal fees by 2%. Customers can't easily switch because the alternative is rerouting through a different port entirely. The numbers tell the story. Maersk's annual revenue hovers around $60 billion. But here's what matters to a forensic accountant. Only about 30% comes from container shipping itself. The rest comes from terminals, logistics, warehousing, and software. Shipping is the loss leader. The ecosystem is the profit engine. Then came 2020. The pandemic hit, supply chains fractured, ports closed, ships couldn't move, Maersk's terminal business cratered, but something unexpected happened. Container rates exploded. A single container from Shanghai to Los Angeles, which normally cost $2,000, suddenly cost $20,000. Why? Because every other shipping company had cut capacity to survive. Maersk kept sailing. In 2021 and 2022, Maersk made more money than it had in its entire 116-year history. Net profit hit $17 billion in a single year. But here's the critical part: that wasn't sustainable, and Maersk knew it. When rates were at peak insanity, they didn't expand capacity. They paid down debt and bought back stock. They understood this was a temporary windfall from chaos, not a new baseline. Today, rates have normalized. Maersk is back to single-digit profit margins on shipping. But the company has evolved again. It's investing in decarbonization, methanol-powered ships, carbon offset programs. This isn't altruism, it's positioning. The EU is implementing carbon tariffs. Container shipping generates 3% of global emissions. Regulations are coming. Maersk is betting that first-mover advantage in green logistics will command premium pricing. So how does Maersk dominate? Not through shipping, through control. They own the ports, the terminals, the forwarding companies, and the software platforms. They move 4% of global trade because they've made themselves indispensable at every step. A customer can switch to another carrier, but rerouting an entire supply chain through different ports, different terminals, different software, that's friction, that's cost. That's why Maersk wins. The business model is simple once you see it. Monopolize the infrastructure, not the service. Everyone needs to ship. But when the infrastructure is owned by one company, that company doesn't compete on price, it sets price. And here's the final trick: because Maersk owns so many pieces of the system, it can absorb temporary losses in one segment by raising prices in another. Shipping margin drops, raise terminal fees. Terminal margins compress. Raise forwarding rates, the customer pays either way. This is why Maersk has lasted 120 years while countless competitors have vanished. It doesn't win through innovation or efficiency alone. It wins through structural advantage, the ability to make switching costs so high that customers have nowhere else to go. Every container that moves through a Maersk terminal generates revenue. Every container that moves on a Maersk ship generates revenue. Every container that moves through Maersk software generates revenue. Most customers never realize they're paying Maersk 4 times for a single shipment. The lesson here isn't about shipping, it's about how enduring businesses are built. They don't win by being the best at one thing. They win by owning multiple layers of the value chain, then making those layers interdependent. Maersk doesn't move the world's goods because it's the best shipper. It moves the world's goods because it owns the infrastructure that everyone else has to use. This video is for educational and informational purposes only and is not financial advice. Always do your own research. Subscribe to see how the world's most dominant brands built their moats, one structural advantage at a time. This video is for educational and informational purposes only and is not financial advice. Always do your own research.